So let me first introduce Alan Gray. Alan Gray has founded in 1973, and we've been managing money for over 40 years with what I'll call a contrarian-based valuation approach. And it's worked fairly well for the last 40 years. So I want to talk a little bit about contrarian investing in Africa, and does it really work, right? And secondly is address the question of what are the opportunities we're seeing in the rest of the continent using this contrarian approach. I think the first question is really, has contrarian investing worked, right? So what this chart shows is on the red bit, the returns on our Pan-Africa fund since 1998. So over the last 16 years, this fund has compounded at about a 24% in dollars. The bottom bit there shows some of the equity market returns in some of the other markets, Kenya, Egypt, Nigeria, and the black line shows the MSCI World Index. And I show this chart to really illustrate the point that over the long term, this has been a period of significant wealth creation for our clients. But it's really the how, right? It's really the how that matters, more than this slide. And that takes me sort of to the next bit, which is really, we've heard a lot about this Africa Rising theme, and you could feel a slide and a presentation with all the stuff that we've talked about earlier today. And it's needless to say, it's based on things like, predicated on things like GDP growth, demographics, etc. And I like this chart because I think it just illustrates that point in a different way. And what it does is, Ernst & Young has gone and done a survey, and they've asked business leaders to rate Africa relative to other markets in terms of attractiveness, right? And you can see it's rising. Now, what has been the experience, though, for equity investors, right? Which is what we think about a lot. And what this chart shows is global equity returns relative to GDP, right? So the bottom bit shows, and it's done over multiple decades, the 1970s, the 1980s, the 1990s, the 2000s, right? So over 4 decades, plotting annual real GDP per capita growth relative to annual realized equity returns. Now, I'm not sure what conclusion you can draw from this chart, but my conclusion is you can't draw a conclusion from it, right? It's not correlated. Now, if I gave you the opportunity to go back in the 1990s, and I told you the Asian tigers are going to have an amazing decade, right? Which is what that red line is, of productivity and growth, etc. And then I told you, I want you to place your money. I want you to bet on the equity markets. What would your returns have been? That's the blue line, right? So as we sit here today and we talk about the amazing decade that could be ahead of us of African growth, we think a lot about this chart. It may not translate into real equity returns for investors. And I like this quote from Jim Grant, a value investor, and he says, for the investor as opposed to the statesman, macroeconomic growth places a distant third to price and value. We spend a lot of our time thinking about those two things. What's the price you're paying today? And what is the context really of the market and the sentiment that's giving you that price that you're paying today? And what's the value of the asset? That's what we spend the bulk of our time on, and less on sort of the big macroeconomic themes. Now, it takes me to the second narrative, and this is really one of uncertainty and volatility. And I think a picture best illustrates this, right? People hate uncertainty. You put up a picture of Mugabe on the picture, investors don't like this, right? But I'll give you an example of stock valuations. So on the right-hand side, or left-hand side, is PE multiples in Nigeria, right? The Nestle's, the Unilever's, 30, 40 times earnings. People are bullish, right? On the right-hand side, good companies on low multiples. Why? Big discount for the macros, right? Now, we spend a lot of time looking at price and value from a bottom-up perspective, and you might ask, are these companies any different? Is an Econet any different? And, let's put the macro issue aside for a minute. Let's just say it is what it is. Let's just put it aside. Look at 2 companies, Econet and Safaricom, right? And the first set of multiples shows you on a subscriber basis, EBITDA margin, return on equity, they're pretty much similar businesses, right? But one is on 11 times earnings, and the other one is on 22 times earnings, double, right? And you say to yourself, well, what's the difference? Well, people are very bullish on M-Pesa, et cetera, but Econet has EcoCash, right? In the last 1 year, EcoCash has 1.5 million people using it. The entire banking sector in Zimbabwe probably has about 875,000 people in 1.5 years. The prospects of a business in Zimbabwe are actually strong if that business is, depending on the competitive landscape. They spent about $1 billion over the last 5 years building their capex in an environment where there are few competitors that want to go in because of the macro risk, right? In Nigeria, what's happening? We're seeing returns on equity come down because there's, you look at Nigeria breweries, you look at Diageo, you look at Guinness, people are going in. Returns on capital is likely to go lower, and the competition is increasing. Now, Egypt has been a very good example because if you call yourself a contrarian, the markets are going to test your conviction. We know that, right? Now, this chart shows in the gray shaded part our percentage of exposure to Egyptian listed companies, right? And the light bit shows Egyptian exposure for foreign listed companies. So it's our total Egypt exposure in our Africa XSA fund. And the red line shows what the stock market, the Egyptian stock market has done. Now, if you had the foresight to invest in July, Egypt has been the best performing market. Over 80, 90% in dollars, 1 year. It doesn't show up on the list of anybody's big GDP growth numbers over the last year. But what was happening, right? So between Jan and July was a terrible period, right? Morsi gets ousted. Just before he gets ousted, there's massive protest. Egypt gets downgraded. Had to get your cash out. Anything that could happen was going wrong with Egypt. But yet, that would have been the best time to invest in Egypt. It's very difficult because you sit there and you're like, we ask ourselves the question is, could Egypt be a failed state? And it wasn't an obvious answer, right? When you're back in those periods. Now, how do we build conviction, right? One of the companies we've held in Egypt is a company called Eastern Tobacco. It's a tobacco company. We all know great economics of tobacco companies. And this is a company that at the very bottom was trading on 6 times earnings. It's related to about 11 times. We still think it's quite cheap. Focusing on price and value. Now, Kenya is a good example. If you think about the Kenya example between 2011 and 2012, they had a massive currency crisis, which is the shaded part there. But look at what the stock market is doing. Now, sometimes it's not illogical what investors are doing, right? So what is happening is local investors will get out of the equity markets because they're getting 20% yields in local currency yields, right? In the fixed income space. But at that point in 2011, 2012, you were getting Safaricom on 11 times earnings, right? Today, you'd buy Safaricom on 22. Great business, same business. To go back in time to buy Safaricom, as well-rated as it is today, you need episodes like this, right? Where sentiment is negative. And you get the double effect, right? The currency strengthens, and you're buying cheap equities. On the dollar terms, it looks very nice. Now, Ghana. It's been a chart of great torment for us as the currency continues to weaken. I hope there are no Ghanaian policymakers here. But some of these crises are actually man-made crises, right? It's policymakers making poor decisions. But we like to think that it tests our conviction when we think with a longer-term horizon. That little bit there that you start seeing when it starts to correct happens sooner rather than later, right? We're investors in the fixed income markets as well, and we've been looking at this chart from a local currency as well as a dollar exposure to Ghana. But we think these episodes of market dislocations happen with a greater degree of regularity across the continent than what people will credit the markets for, right? And we just have to be patient and have a longer-term view. Now, I mentioned our history started in South Africa, and you hear a lot of talk about sector focus, etc. What this chart shows is indices relative to the stock market, for the South African stock market. And so, for example, if you look at the green line, if it was a straight line, that means it's performing in line with the market. When it's going up, it's performing better than the market. When it's going down, it's performing worse than the market. And those are the three sectors. So we have industrials, financials, and resources. Now, I'm not sure this pointer is working, but between 95, let's call it 97, best time to invest in resources, because you get the nice big upswing. But what had happened prior to that point? You had a massive period where resources underperformed, right? On the right-hand side there, I show what our exposure to resources was at that particular time in the South African markets. Keep in mind, the chart I showed you at the beginning started at this point. You build conviction to say you don't want to own the shares that you think are expensive, you want to own the ones that you think are cheap. And there's a risk of being different from the market, significantly even underperforming, right? Relative. So that's the gray shaded bits where we underperform. And we're happy to tell investors that this approach will lead to periods of underperformance. But hang in there, because there's a long-term strategy and a long-term view of why we think this is the right thing to do, right? So I'll finish off on this slide, and it talks about there's a risk of being different if you're contrarian. So this shows the active share of the portfolio, the Africa XSA fund. And what that is, for example, if that was 100%, you're owning a portfolio that's totally different from the benchmark. If that was at 0, you're owning a portfolio that's effectively an exchange-traded fund or an index tracker, right? At 80 or 90%, close to 90%, it's a very different portfolio. And there's lots of things that can go wrong. But we think it's building that conviction to look at the markets and figure out what is it that we need to own, regardless of worrying about benchmark risk or being how close you are to the benchmark. The risk we worry about is the risk of permanent capital loss. And that risk, when we look at this chart, the top chart that I showed you, if you split out per annum returns, we want to avoid the bottom bits when the fund is underperforming. That to us is a bigger risk than the risk of permanent capital loss. Thank you.